We've got a really important topic on our minds today, something I know many of you with, well, second properties in the UK are keen to understand better.
Hmm.
We're diving into capital gains tax, CGT, specifically how it applies to those second homes, and crucially, what completely legal strategies are available for this tax year, 2024-2025.
That's right. And we should mention this discussion has been arranged with the help of the experts at my tax accountant, really well-respected UK firm.
Absolutely. So, CGD, let's start there. What is it, in simple terms, when we're talking about property?
Okay. So capital gains tax, at its core, it's a tax on the profit, the gain you make when you sell or gift or, otherwise dispose of an asset that's gone up in value.
And today we're zeroing in on residential properties that aren't your main home.
Exactly. Your second homes. It can feel a bit complicated, I know, but getting the basics down is, well, it's key if you have these kinds of assets.
Okay, let's get straight to it then. When does CGT actually sort of kick in for a second home? When does this tax become a reality?
Right. Typically, CGT applies when you dispose of that property. And crucially, you make a financial gain from doing so.
Dispose of. So selling, mainly.
Selling is the most common one, yes. But dispose of is broader. It can include gifting it, maybe to family, or transferring it into a trust or even a company. If its value has increased since you first got it, CGT could be on the table.
So say I bought a flat for £250,000, rented it out, then sold it for £375,000. That £125,000 difference.
That £125,000 profit, the capital gain, that's potentially subject to CGT. Now, you deduct allowable costs in your allowance first, but yeah, that's the figure we start with.
Okay. And just to be crystal clear, what counts as a second home in HMRC's eyes? It's not just holiday cottages, is it?
No, definitely not. It's any residential property that isn't officially your main residence. So that covers buy-to-lets, holiday homes, yes,
Yeah.
but also maybe a property you've inherited that you don't live in as your main place.
And you can only have one main residence for tax purposes.
Only one at any given time. That's a really crucial point for CGT.
Right. Now, the numbers. What are the CGT rates for 2024-2025 on these properties?
Okay, for this tax year, on residential property gains, it's 18% if you're a basic rate income taxpayer.
18%.
And it jumps to 24% if you're a higher or additional rate taxpayer. So your overall income level really matters here. It determines which rate you pay on the gain.
And there's that tax-free allowance, too, the annual exemption.
Yes, there is.
Yeah.
For 2024-2025, every individual gets a £3,000 capital gains tax allowance.
£3,000.
Okay, so the first £3,000 of your total gains in the tax year are completely tax-free. And remember, that's per person.
Ah, per person. So if a couple owns a property jointly?
Exactly. They each get their own £3,000 allowance. We'll probably come back to that.
Right. Okay. So we've got the basics. Let's move on to the strategies. What are some perfectly legal ways someone might be able to, reduce or maybe even avoid CGT on a second home?
Well, one of the biggest ones revolves around nominating your main residence. This is quite powerful.
Nominating. How does that work?
You have a window, 2 years from when you acquire a second property, to formally tell HMRC which property you want treated as your main home for tax purposes.
2 years. Okay. Can you give us an example? Make it a bit more real.
Sure. Let's imagine Maurice and Hilda Faraday. They've got their main flat in Sheffield where they live during the week for work.
Okay.
But they also bought a little cottage in the Cotswolds for weekends. Now, even if they spend more nights in Sheffield, if within 2 years of buying the cottage, they nominate the cottage as their main residence.
Even though they're mostly in Sheffield.
Even so.
Mm.
If they make that formal nomination, then when they eventually sell the Cotswolds cottage, they could potentially claim private residence relief, or PRR, on some or all of the gain.
Private residence relief. PRR. That sounds important.
It is. It's the relief that usually means you don't pay CGT when you sell your main home.
So what are the conditions for getting PRR?
Generally, you need to have lived in it as your main home. You can only have one main home. You shouldn't have let it out, apart from maybe having a lodger. No part should be used exclusively for business. The grounds need to be under a certain size, usually 5,000 square meters. And importantly, you didn't buy it just to make a quick profit.
Right. And a second home doesn't automatically get this.
No, not unless you successfully nominate it as your main residence and meet the conditions for the period claimed. That nomination is key.
What if the second home was my main home at some point, but isn't anymore? Say I lived there for a few years, then rented it out.
Ah, good question. Yes, you might get partial PRR. The period it was your main home is generally exempt. Plus, there's another useful rule. The last 9 months of ownership nearly always qualify for PRR, regardless of how you used it then.
The last 9 months, even if I was renting it out.
Generally, yes. So imagine you owned it for 10 years, lived there for, say, 2 years, rented it for nearly 8. Those first 2 years get relief. The final 9 months get relief. It's that middle chunk, the renting period minus the last 9 months, where CGT might apply.
Okay, that's really helpful to understand how it breaks down. What's another strategy people should know about?
Joint ownership, especially for married couples or civil partners. We touched on the allowance.
The £3,000 per person.
Exactly. If you own the property jointly, say 50-50, you can combine your allowances. So potentially £6,000 of the gain is tax-free, instead of just £3,000 if one person owned it alone.
So like Neville and Bernice Hoyle with their Manchester rental. If they own it together,
They could potentially shield £6,000 of profit from CGT just through their combined annual allowances. It can make a noticeable difference to the final tax bill.
that makes sense. And what about actually transferring ownership between spouses or partners? Is that a thing?
Yes, absolutely. Transfers of assets between spouses or civil partners are generally done on a no-gain, no-loss basis for CGT.
Meaning no tax is due when you transfer it.
Correct. At the time of transfer, there's no CGT. This opens up planning opportunities. Imagine Rodney Trench is a higher rate taxpayer, and his wife Jill has little or no income that year.
Okay.
Rodney could transfer full or partial ownership of the second property to Jill before they sell it. Then when they sell, Jill can use her own £3,000 allowance. And crucially, any gain attributable to her share might be taxed at her potentially lower rate, maybe 18% instead of Rodney's 24%.
Ah, I see. So you shift the potential gain to the partner with the lower tax rate or unused allowance.
Precisely. It's a perfectly legitimate way to manage the overall tax liability for the couple.
Got it. Now, you mentioned allowable costs earlier, reducing the gain. What sort of things count? And how does record keeping fit in? You mentioned Neville and Bernice again, if they jointly own and spend money on the place.
Right. Record keeping is absolutely vital. Allowable costs aren't just the buying and selling fees like solicitors and estate agents. They also include capital improvements.
Capital improvements, not just repairs.
Exactly. Not routine maintenance like fixing a leak or repainting. We're talking about things that genuinely enhance the property's value, like adding an extension, a new conservatory, maybe a significant kitchen upgrade.
Okay.
You need proof. Invoices, bank statements showing the payments, and if it's jointly owned, like Neville and Bernice, you ideally need records showing who paid for what or that it came from a joint account used for the property. These costs directly reduce your taxable gain, so good records can save you real money.
Sounds crucial. Any other ways to reduce that taxable gain figure itself?
Yes. Don't forget about offsetting losses. If you've made a loss on selling other assets subject to CGT, maybe shares or even another property in the same tax year, you can use that loss to reduce the gain on your second home.
Okay, so losses can cancel out gains?
Effectively, yes. And what's more, if your losses are bigger than your gains in 1 year, or you have no gains to offset them against, you can usually carry those losses forward to use against gains in future tax years.
Indefinitely?
Generally, yes, until they're used up. So keeping track of losses, even small ones, is really important for long-term tax planning.
That's a really valuable point. Okay, before we wrap up, any final really important reminders or things people absolutely need to keep in mind?
Yes, a few key things to flag up. Firstly, we've said it, but records. Purchase price, sale price, dates, all those allowable costs, solicitors, agents, those capital improvements, keep everything safe and organized.
Definitely. What else?
Second, be aware of the reporting deadline. Since April 2020, for UK residential property sales where CGT is due, you have just 60 days from the completion date to report the gain to HMRC and pay an estimate of the tax owed.
60 days. That's quite tight.
It is. You usually do it through HMRC's online UK property CGT account. Miss the deadline, and you could face penalties and interest. So you need to be prepared for that quite soon after selling.
Okay, 60-day rule. Got it. Anything else?
Just a quick point on inheritance. Inheriting a property itself doesn't trigger CGT, but if you later sell that inherited property, and it wasn't your main home while you owned it, CGT could be due on the increase in value from the date you inherited it to the date you sell it. So getting an accurate valuation at the date of inheritance is really important. That sets your base cost.
That's a very important distinction. This has been incredibly useful, really breaking down a complex area. It seems clear that legally managing CGT on second homes needs, well, proper understanding and careful planning.
Absolutely.
Yeah.
That's the main takeaway. There are legitimate routes using the rules, exemptions, reliefs strategically. but it does require you to understand HMRC's framework and plan ahead.
And given everything we've discussed, the nuances, the different personal situations, what's the final word for our listeners?
Well, look, everything we've talked about today is for general guidance. Tax is complex, and everyone's situation is different. Your income, your property history, your marital status, it all plays a part.
So professional advice is key.
It really is. When you're dealing with potentially large sums and property, getting advice tailored specifically to you is the sensible way forward. For that kind of personalized guidance on capital gains tax for your second home, we definitely recommend reaching out to the team at My Tax Accountant.
They can look at your specific details and help you navigate it properly.
Exactly. They're the experts who can provide that specific advice you need.